ready to roll. So we're going to dive into how you can get ready and capitalize on this earnings season. It's going to kick off next week. Well, actually, it kicked off last week with a couple of earnings from the airlines, but next week we get into the banks and everything. So really excited about earnings season, actually, because there's so many crazy things that go on. So if you know how to trade it, there's a lot of opportunity here that exists. And so that's what we're going to kind of get into today, show you a number of different top option trade strategies you can take advantage of to, kind of trade the earnings season. So again, that being said, let's get started. So a little, background on myself. I've started my trading career or journey back in the 80s. I was fortunate enough to get a job with a company called Coastal Corporation. And at that time, that would actually, we're training, different traders and stuff to trade oil for, the refining supply demand, things like that. So they had, programs for trading for crude oil and products and all that stuff. So I was able to get into that program. It was pretty exciting. They first sent me down to their refinery in Corpus, Texas, and it was a big refinery that they had down there, and they had a number of different refineries. And so spent about 3 months there. So it's a great experience to kind of learn the foundation of oil, how it works. They bring it in on these big tankers and put it through the distillation units, and you just kind of learn the whole concept of how it all works and flows together. And so ended up in their shipping department, chartering tankers and doing all that stuff, and for a while, and then finally got onto the trading desk on the cargo side, and spent about 5 years there at Coastal. 2 of those years they sent me right out pretty soon to Singapore, man, which fantastic experience out there trading the Asian crudes and a lot of different products. If you ever get a chance, make sure you hit Singapore. It's just a fantastic place. Great food, a really energized place as well. And so then ended up with a company, really got a great break here, went to work for a company called Transworld Oil. And at that time, they were the largest oil trading company in the world. So it was Transworld, Fibro, and Mark Rich. And so Transworld was just, in all the different energy sectors. And then eventually got into everything else, but spent about 17 years there with them, and spent 16 of those were in Bermuda, which was their corporate headquarters, which was just a beautiful place. But ended up there for 16, and then ran the international trading desk out of Bermuda for 10, and that's where I started trading options back in 1987 on cargoes of crude, and we were at everything, foreign exchange, all the futures markets. So it was just a really fabulous, fun experience, and stressful but fun. So just had a little bit of background on that and my career, and so let's get rolling here. So the following workshop today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So I want to ask you a question. So have you ever noticed how earnings can be horrendous and the stock goes up? Or the earnings are off the chart, fantastic, and the stock tanks. So this is what I call the earnings confusion. So, when a company has an earnings conference scheduled, many times there's, a lot of speculation, not only into the accuracy of the projected earnings, but also to, other things that may come out of the earnings call, that they're having. So it could be that they're going to, do more data centers, or they're going to lay off people, et cetera. And so things like that kind of surprise or shock the market a little bit that the market wasn't waiting for. So this really creates a lot of potential upside as far as the expansion of, volatility. So it's this uncertainty that really causes that increase in the volatility, in the shares of specific stocks that are announcing. And that becomes the big diamond in the rough, this temporary kind of parabolic rise in volatility and the spike that it has on, prices as well. So this is what we're going to be looking for. So, as a trader, tends to stay on the sidelines, going into the days leading up to an earnings conference call, but then all of a sudden, there's a lot of rush to maybe to reduce risk. So you see a lot of call buyers coming in, swapping out maybe their long shares of stock for call options so they can participate in a rise should the shares move higher, but they want to limit their potential loss should the shares move lower. So you get this big surge in demand from the call buyers, swapping out shares. And then you also get the additional put buyers coming in, forcing the options higher as well as they try to protect their positions from any major downside movement. So it's all this concentrated option buying that in many cases will drastically expand the volatility level of stocks being traded into their earnings release. So, as an individual trader, then you can take advantage of all this uncertainty and volatility in order to capture those profits, no matter what the crazy earnings reactions are. It just comes down to knowing, what type setup to use, or what's the right setup, and then how to trade it. Now, step one, let's go through the steps that I look at, when setting up these types of trades. So we want to first identify and qualify a particular stock by looking at its past earnings performance. So we want to look at the probabilities of what that stock has done in the past as it heads into its new earnings release cycle. So we want to be looking for those stocks that have earnings released during the weekly option expiration. So we want to take advantage of the weeklies and short, fast duration time frames, not anything long out into the longer duration. So it's really important to look for the fast movements, and so that's why we use the weeklies. So we want then to evaluate the past performance. We want to look to see what then volatility has done in the past to a specific stock as it moves closer to its earnings release, and then even after, to see if there's any kind of opportunity in this thing, or see if there's a repeatable pattern of a specific thing that these specific stock may do. So that's really key. So as a prepared trader, we look for that dramatic increase in a stock volatility as it approaches the earnings release. Now, normally a stock will be around 25 or 40% implied volatility levels. But the weeks of earnings are leading up to it, this volatility can really expand and go to really extremes as it gets closer to its earnings release. And especially as it gets, into the week of the earnings release. So this really makes a stock a potentially great profit opportunity. So it's this volatility that sometimes will double, and in other cases, even go to extreme levels of that, more than a double. So we really can see a lot of expansion in the volatility. And then you add on top of that, if the markets are extremely volatile, like we saw Friday, there's a lot of stuff that's going to happen and a lot of potential opportunity that we're going to have. Now, here's an example of what you can be looking for and see from this volatility expansion. So this is just a really good example. This was on NVIDIA, and look where NVIDIA was trading. It was trading at 270. So this was a past example, but the earnings are typically on NVIDIA will be released on a Thursday after the close. All right, so this was on the 13th, and the expiration was the next day. So going into the earnings release, NVIDIA is trading at $270 right here. So you can see 1 day to expiration, and look at the implied volatility. It's showing over 114% implied volatility. Now, normal implied volatility, if you look back, is around 40 in that range. So right here, you can see this Thinkorswim, the expected implied move for just this 1 day is $17 up or down. So that's basically like just a one standard deviation move, $17 up or down. And a lot of times in these earnings, we can see double or even close to triple, 3 times the normal implied volatility. But that's what you can expect and what you're going to be seeing a lot of this earnings season. So you can see over 114% implied, and then you look, the next series 64, and then on back. Now here's what it did then the day after earnings. So here it was at 270 on a Thursday, and then the next day it collapsed back down to the normal range. So you can see then the implied volatility is back down a little bit over 35%, and back more to the normal range. Now, not only did implied volatility collapse, but you had the price go from 270 to $291 per share. So not only did you have volatility crush, but you also had a price and spike of 7.5% up to 291. So that presents a lot of different ways that we can trade, stocks like this and take advantage of that either volatility crush or potential big price spikes up or down. So here's the chart to kind of show you more detail of this. So it was trading right here going into the earnings release. You can see the implied volatility here, this kind of teal colored blue line, was just kind of expanding all the way up. And then after the earnings release right here, volatility collapsed. So, all the uncertainty now is out of the market. The market has, absorbed everything, and that volatility comes off. But not only did the volatility come off, but price in this example spiked up 7.5%. So that's a lot of times you're going to see these kind of price action movements, and the volatility is going to always collapse after the announcement. All right, so that's just a good example to show you what you can be looking for. Now, it's for this reason that it's essential that you have a watch list of stocks that you can monitor closely. So you can see that, they're not all going to be kind of that equal trading opportunity. Some are going to have these big potential moves while others are not. And it's just based on looking at their performance in the past to kind of get an idea of the consistency that they may have. So remember, the goal is to take advantage of this temporary rise in the volatility, as well as, the past earnings performance and the potential probabilities of those, past performance of what they could do on a future earnings release. Now, there are three types of earnings cycle trades that we can look for. So the first one is kind of a trend trade, as a specific stock heads into their earnings release. Now, the second type is what we call a non-directional trade. So this is actually a trade that you would put on for the earnings release, and it's non-directional because we don't know, is the stock going to go up or is it going to go down? So these are kind of trades that we can plan out for that. And then the third one is a kind of a post-earnings trend trade, that a lot of times, certain stocks may have a really great trend, after their earnings release. Maybe they have blowout earnings and it keeps trending up, or it could be the other way around. They could have a, poor earnings results or a surprise there, and it starts trending down. So these are kind of three cycle trades that we can look for. So here's a good example. This was back on CRM, and it actually had all three of them in this specific earnings cycle season. So here's that trade one. You can see it's starting to trend. Here's your implied volatility here going up. It's going to always go up because of the uncertainty, so it's going to build up to the upside. Now, in this example, though, CRM was also, before the earnings release, it started trending higher. And that's pretty typical, when you have a specific stock that you think is going to have good potential earnings, then the market's going to always be ahead of it, right? Maybe a week, 2 weeks ahead. And so here you can see CRM, the market was anticipating or expecting some good earnings results. So for that reason, you can see the price was just trending higher. So not only was price trending higher, but you had the implied volatility trending higher. So in this kind of trade, what we will typically do is we'll go out and we'll buy some kind of the calls or whatever, or a call spread or something like that in that earnings season series right here, to take advantage of, one, the price movement to the upside in this example, and two, for the increase in the implied volatility. So that's going to increase the option price as well. Remember, implied volatility goes up, that increases or has an effect on the option value. So we get the option price going up, and we get the implied volatility going up. So we have a really good, nice push to the upside, on the value of the option in this example. So that's kind of that trend trade one. Now, trade two is the type where you're looking for you don't have any idea what's going to do. It could go expected, could rip up or down. And so this would be your non-directional trade, where you're just looking to trade for a potential either price spike up or down, or just the volatility collapse. So you can see here that volatility collapse, and it also had a big spike up and a spike down on this. Okay, so that's kind of that earnings trade two you can look for, that non-directional. So what you want to do if you do trade one, where you're trading into that cycling up or down into the earnings release, you want to be out of that trade before the earnings are announced, and then, or keep it on if you're going to look for a directional trade. But two is a non-directional trade, and we'll go through these here today in this workshop. And then three would be your post-earnings trend trade. So you can see here, it had that move and closed here, but then it started trending back up off the good earnings. So that was your post-earnings trend trade. So we can look for that. And a lot of times when we look at past performance, we're going to see these kind of potential tendencies in a specific stock. Right, so that's a look there. And here's just one more example. This was Nike. And you can see here that Nike was just kind of moving down, as you can see, into earnings, but implied volatility was up, and then it collapses. Here's another one. Here's the earnings release date here. You can see Nike, the price is trending down, but the implied volatility is trending up. So in this situation, you would have bought puts out here in this series, and we're able to get the benefit of the price moving lower, plus the implied volatility on those puts moving higher. So your value is going to increase there. So these are things you can look for, and these are the types of trades that I always like to look for and use for our members in our trade room or the alert service that I send out. All right, so step 3 then is to kind of put together and use what I call a pre-earnings kind of systematic checklist. Okay, so I like to try to keep things kind of systemized as you can to kind of help take your emotions out of your trading. So kind of make it mechanical in the steps you can, do those step by step, for these types of earnings trades. So first off, we want to look for the, stocks. They have to have options to begin with, and good option liquidity. And typically, we're only going to look for, those stocks that offer weekly options. Very important there. So we're looking for typically high pre-earnings volatility, from the stocks as they head into their earnings release. And then I look at, past price movements. I want to look I kind of put together a screen of 3 different types of things that I'm looking for. So I want to see past price movements that on the average have a greater than plus or minus 5% move up or down. Or I'm looking for another kind of screen where I'm looking for those stocks that tend to have no movement of more than 7%. So, 5 to 7% kind of max movement. And I'll go through and show you some examples of kind of why I look for this. And then I'll look over usually the last 4 cycles or 5 cycles to kind of look for these consistent kind of patterns of data. And then the other thing, that the price that I'm looking for on my screen, I typically $30 or more per share for whatever stock you're looking at. So if you get too low, it's just not enough, dollar potential profit based on the low price of the stock. So that's an important part as well. Now, the next thing is we want to first, before the earnings are released, we want to make sure we calculate the implied stock move the day of its earnings announcement. So we want to get an idea theoretically of, what the market is telling us that price could do either up or down, to give us kind of an idea of the standard deviation movement. And then we can kind of formulate and step into potential targets that we're looking to achieve to the upside or downside. So that's a very important thing to do as well. Then we perform our earnings price target analysis, of targets up or down that we're looking for. That helps us to select the appropriate weekly option strategy to use, put together our entry plan, determine our exit plan, and we're ready to trade. All right, so here's kind of an example of kind of how I go through this. This was on AKAM. So here's kind of a data analysis. Now, before I go any further, I thought I'd make sure that to point this out, next week I'm going to be doing a full detailed course on these earning strategies that we're going to go through here today. So this will be next week, starting on Saturday, the 18th of October. So if you have to leave early today, maybe you've got a football game where it's beautiful outside, make sure that to take advantage of this course that I'll be offering next week. So it will be live and recorded. And let me give you the link here so you can get this discount on the course if you sign up today. So use this special link here. You can either click on it or copy and paste it. And then when you do that, it's going to pull up a payment link for you. I'll show you what that looks like. And then you can put in the promo code, which will be EARN15. So first off, just kind of go through the pricing packages here. Package 1 will be just the course, which also includes a number of different bonuses that we'll go through here a little bit later. But the price when I go out to my members, my list this week will be $197. But if you sign up today using the promo code EARN15 right here, small cap EARN15, you'll get this course for $167. That includes, the live course recorded and everything, plus all the bonuses that I'll go through. So it's got a really good bonus package here. So you're basically getting this for 30% off, discount of the full package. Now, the second package is that if you want to include this with my earnings alert service, it's going to be $597. It's the normal price as I go out this week, but if you use that code here, EARN15 small cap, you'll get this for 15% off. And that also includes everything, the live course, and then all the bonuses as well. So with this package, you get the 4 months to the alert service. I have 5 different types of alerts I send out. That also includes 4 months to the Power Cycle Trading Club, which includes, Q&As every week and a live trading room that you can, come into. So again, please take advantage of this, and this will start next Saturday at 11 a.m. Eastern to 2 or however long we need, and then we'll finish up with Monday night, the 20th at 4 p.m., and we'll have a dedicated Q&A for it the next day. All right, so that's something to take advantage of. And here's what you'll see when you put that link in. So here's the link one more time, and just click on that. And then what you can do is click or copy and paste, and it will pull down or pull up this drop down payment link page here so you can see all the details. So, put again, EARN15 small cap. Let me just put that in for you if you want. So EARN15. So put that into where you see the promo code. I'll show you that. Now it gives you kind of a summary of everything you're going to get, so you know what you're getting when you buy it. So you can see here just kind of a brief review here. If you do course package 1, you get access to the live course, which will also be recorded. And so that's over $1,600 there. So my price will be $197, but today $167 plus. You're going to get these additional 6 bonuses here. So you'll get my 4 hours earning course. This was really on the different earning setups and how the mechanics work, the price action, and the deltas and the Greeks, how that affects these earnings trades. So this will be something you'll get on demand right away as soon as you sign up. You'll get this probably Monday. And then the bonus 2, you'll get my option trading course, Start Trading Options Today, just an additional option course on different option strategies. And these are the prices on my website. If you go to the website, Power Cycle Trading, you're going to also get a 30-day trial membership to my trading club, $97 if you keep on, or we have other price packages for you. And that includes your trading club. You get access to my trading room, Q&As, and a lot of other stuff that I'll talk about here towards the end of the course. You got to go through that. Plus, we'll do a follow-up dedicated Q&A for the earnings course. That'll be on Tuesday next week. And then one more thing, you'll get my How the Pros Use the Greeks. So a nice little a tutorial on the Greeks, a video recording of that. And then I'll give you my trade list for the best earning stocks coming into this earnings season that I do my scan for. So this is all, over $1,000 here, $2,600, and use that promo code today. It's going to be $167. So if you scroll down here and click on to buy now, you're going to see everything listed here that you'll get, and then you put that promo code in there, EAR. Let me spell that right. EARN15 small cap. Click apply, and you're going to see the 167. Then you use PayPal, credit card. Now, also, if you do want, we do have a 2-pay that you can have if you'd like. Plus, I'm offering my indicators, which are my directional trading indicators. If you'd like to add that to the cart, you can here for $195. And these are available. You can get all these in platforms. Just select whichever one you want. You can have one or all of them. Thinkorswim, TradeStation, NinjaTrader, eSignal, TradingView. All right, so that's everything now. And course package 2, like a quick review there. This comes with my Elite Trading Alert Service. So this is 5 different type of trade alerts that I send out. And so you'll get these for the next 4 months, plus 4 months to the trading club, and everything in course package 1, all the bonuses in the course, live course, etc. Now you can start this whenever you want, and you can start and stop. If you go on vacation or something, you can start and stop your time, so you're not going to be use it up. And so here's just a quick overview of past performance. These are unaudited, but you can see what we've done. Really had great results. And so this is just for current year 2025 through Friday. We've had a win break-even rate of 85%. Okay, I'll go through this a little bit more later, but we've had over 104 trades closed out, 74 winners, 14 break-evens, 16 losers. So running 85, really high win rate result there. And then overall, since inception, we've had, since I started the first part of the alert service back in 2018 through Friday, we're running at a 79% win break-even rate, 936 trades closed out, 672 winners, 69 break-even, 195 losers. Again, unaudited, but just a kind of a summary of those results. So really great results, and then that's what you get in package 2. So 4 months of the alerts, which cover 5 different types of alerts I send out. I'll go through this a little bit later. And the trading club plus everything in package 1. So typically you'll get the 5 alerts, 8 to 12 stocks or ETFs per month. The types of alerts that I send out are kind of either breakout reversals, which could be credit spreads or debit spreads, selective calendar and calendar diagonals. We do a lot of these. Selective butterfly long condors, do a lot of those. Selective earnings trades, which we'll go through. So we'll start doing those this earnings season, very selective trades there. We're running 85% win rate on these, which I'll show you here in a few minutes. And then selective kind of what we call butterfly penning trades. So when I send these out, you get a trading guide. I do a setup video review of those. Trades are listed and archived. You also get then access for the next 4 months, access to my trading Q&As, trading room, market video newsletter update every day, and then my virtual trading room and 50% discounts on anything on my website. So just kind of a summary of that. In my trading club, you get access to my trading room, my Q&As every week, daily market video review updates, video archives that we have, and traders educational vault, and then 50% off discount. So go through this. It's $597 when I go out this week, and today if you use that promo code alert our earnings earn 15, it's 507. So just click this course package 2, and that will pull up your payment link here. It lists everything you get here so you know what you're getting. And then come down here, there's also TwoPay, EARN15, put that one in, that code in there. Click apply. If you want TwoPay, you're able to do that. And also, if you do want to add the indicators, you can do that as well. So that's kind of a quick summary of that. And we'll come back later to it if you've got questions, and we'll go back over it. But I wanted to make sure that I got that out to everybody before, in case you had to leave early. So here it is one more time, and then put in the EARN15 small cap promo code, and you're ready to go. Okay, so feel free to ask more questions later on this. And okay, one more thing, if you think maybe you've purchased it in the past, here's where you can make sure and find out. So if you go to your personal PowerCycle Trading account tab, you'll see on that tab everything that you bought prior from me. So you could have bought my butterfly course, calendar course, whatever, but you'll see earnings. So if you bought this in the past, that will show up right there, so you'll know. Or you can let us know, and our support will help you out there if you're not sure as well. All right, just to point that out. Now here's AKAM, getting back to it. So you can see the implied volatility here was huge as it goes into its earnings release date. Here you can see it's 1 day. This is like on a Thursday. The earnings will be after the close. So AKAM here was trading at around 98.18. Close was after the earnings on the 20th, and then the expiration was the next day. So look at the implied volatility here, just 1 day into earnings release, over 238% implied volatility. Now, normally, it's around, 50 to the high 40s, but huge, like 3 times the implied volatility. So this, for one standard deviation, 1 day, 238% implied volatility. the market implied volatility is telling the market that this thing could go up $10 up or $10 down in one day. Now that's one standard deviation, and you're going to see here later that a lot of these stocks sometimes can do two times that and even higher. All right, so you can get some crazy movements in the market, and this earnings season we're going to definitely see this kind of movement. So here you can then see the next day it just collapsed, right? That earnings volatility spiked up, and it's still high, but look at it collapsed down to 134, and you can see the normal volatility has been in those high 40s. Now, not only did that happen, but the price went from 98 the next day. Now it was down to 77.94. It was down 20%. You know, that is huge. So that was over 2 standard deviations. The implied expected move was looking for a move down of $10, which would put 88 was roughly going to be the downside implied move, and this was like the 77. So just to point out the extreme movements and the volatility crush that you get from these types of trades. Now here's kind of the backup data that I looked at to kind of get the analysis to determine what kind of trading strategy to do. So here was that AKAM. You can see this was on the 7th of November. The straddle price and the implied move was, market was calling for a $9.85 plus or minus move up. And then you can see that was about a 9.4% right implied expected move right there. So here you can see the past earnings. They're all for AKM high potential movements, 12% up or down, 9, 6. Now the next thing I look at though, the most important thing is then, okay, what did it actually do, at closing the day after its earnings release, or the week at the expiration date. So this was on a Thursday, and here's where it went out one day later, the next day on a Friday, right here. So you can see this in this example, it was up, it was down 14. Well, this was 222. You can see it was down 21%, and this thing collapsed down over 14% down. And you can see the other ones. The AKAM has potential big movements. Here was a 10% up, 10, 11% down, 8, et cetera. So that's the kind of stuff you want to look at to see what specific stocks do. So when I'm, analyzing AKM or something like that, what does it say? It says, man, this thing can have some huge movements. So we want to kind of, if we want to take advantage of that, there are certain strategies that we can do to take advantage and trade it. So we'll go through that here. Now here's kind of, more detail. So, you can lay it out, make it as detailed as you want, put it on a spreadsheet, but here it is, kind of on the spreadsheet so you can see more detail. So here was the closing price pre-earnings on AKAM. So this was in this particular example, on the 7th of November, it was trading before the earnings release was at 104. The implied move that the market was looking for based on the straddle price was 9.4%. And then you can see this goes back 5 cycles. So then you can see, past performance in this example going back 5 cycles. This has potential for big moves. Here it was 12.6 up or down, 9% up or down, 6.5 up or down, 9.83. So potentially big moves on AKAM. Now, then what I do is look for, okay, what did it actually do at expiration to see if that kind of aligns with the expected move forecast. So the 5 earnings cycles here had an implied expected move history of 9.5% up or down. So potentially for big moves, right? Now, this is what it actually did at expiration. So you can see here, just looking at the past 5 cycles, it was down 4.39, up over 10%, down over 10%, down 8%. And here was the smallest move here, 1.56, but the normal moves are big. So you can see here, this was the average of that. And then going back even further, I look back at 9 cycles, and you can see the average up or down move was 10.55%, the smallest being 1.56. So what this tells me is this has a potential consistent trading kind of pattern that it's going to have a big price spike up or down. So then that tells me the kind of strategy that to employ if I want to trade a stock like AKAM. And we'll come back to this and I'll show you some examples. Now, the next thing is the power of the weekly options that we use. So I like to use weeklies because, you know, for all the earnings trades, because this takes advantage, really great advantage of the two really key option pricing components, which will be the time value and more especially for the earnings volatility is the implied volatility, which has that you know, tendency where it really spikes going into the earnings announcement. So the combination of these kind of two pricing components, when used correctly, this really creates some great low cost defined risk trade setups. And this kind of a formula that I put together to help generate these kind of high returns in a very, very short period of time. So it's kind of what I call the lightning in the bottle kind of trading, because you know we do these steps over and over, and we can capture these profits. It gets pretty exciting. I used to have one of my bosses would get so excited when we'd have a great trade. He said it's kind of like lightning in a bottle. You know, bottle it up and let's do it each and every time. So that's what I look for on the weekly. So if you just know which weekly option strategy to use, when to use it for that earnings trade, how to construct it, and trade it, then these can produce some very exceptional fast profits due to the great leverage that you're going to get, and they're the kind of the great trading vehicle for, you know, your earnings trades. So the next thing is, well then, you know, how do you figure out which option strategy to use? Okay, so this is what I call kind of my comparative option strategy analysis. Okay, so what this does incorporates is to help you to figure out the best trade strategy to select. And so it's going to be really coming down to the risk to reward, or the return on the capital that you're putting at risk between the kind of various strategies you could use. So there are a number of different strategies you could use for each kind of earnings trade. But if you really want to, weed it down and scan it to the best results for you, then the way to do it is you want to compare those strategies based on the risk to reward. So what is the reward of that trade based on the risk that you're putting up, okay? And so that way we can then kind of filter through and determine what strategy to use. Now, the strategies that I will look to use, there are 5 different types, okay? And these can be done to either capture profits from the extreme volatility that we see that surrounds every earnings season, and then, or we're looking for those that have these big price spikes. So there are 5 different strategies that I'll look to use. Now, here's kind of a list that I'll go through and I'll show you through today. So the first one is what we call the short iron condor spread. So this is basically, it's actually a debit spread, and this is created and set up for big price spikes. So when we're going into the earnings release, we have no idea if it's going to have great earnings or bad earnings, and if the price is going to go up or down. But some specific stocks, like you saw from AKAM, have a tendency to have these big price spikes up or down. So this strategy will help to trade that kind of price spike up or down. It's a defined risk trade strategy, and so we'll go through what that is. Now the other one, the next one, is what we call the long iron condor spread, and this is actually a credit spread, and this is done for volatility crush. Okay, so you know that implied volatility is going up, and we know that after the earnings release, all that uncertainty comes out, it collapses. So that's the volatility crush strategy. We'll use that. The next one for volatility crush that we could use is what we call the iron butterfly, also credit spread, also for volatility crush. And then the next one that we're going to go through and I use is what we call the double lightning spread, which is actually a debit spread. And this is a really unique option strategy that we use, and it's basically one that we can use for both volatility crush, the collapse of volatility after the release, and this is also one that is great to capture any potential post-trend trade move up. All right, so it's a real favorite strategy, really unique, and we'll go through a couple examples here on that as well. And then the 5th one is what is the earnings pairs trading strategy. This is a long short kind of delta neutral, but for a post-trend trade. Okay, so it's a pairs trade strategy that we'll go through and that you can use for a post-earnings trade. So 5 basic types of strategies depending on what the market condition is going into, you know, an earnings release. So here's an example of the volatility crush using a long iron condor credit spread. All right, so number one, it's a defined risk trade, also used as a non-directional earnings release trade. I look to screen for specific stocks that have this tendency for this kind of movement, and we'll go through that. Takes advantage of your pre-earnings high implied volatility as it pushes up into the earnings announcement. And what you're doing here is you're selling time and volatility to take advantage of that volatility collapse, which comes after the earnings release. Now, these are typically set up for a short duration, maybe 1 to 3 days. So all these types of trades are, you know, really short duration just to capture either the price movement or the volatility collapse, you know, of your earnings release type trade. So here's a good example on one that we've done on JP Morgan. These are, you know, trades that we've done either in our trading room or the alert service that I send out with the earnings types of trades. So here's one that was for JP Morgan. We'll have this next week, so we'll be looking at potentially this one next week for this kind of trade. Sorry about that. Let me get this. All right, so looking back at its earnings history first, kind of the first step, you can see that in this example, it's going to have the earnings before the open. The straddle cost here is 589, so the implied move looking for about 2.84% up. So you can see that JP Morgan is a low volatility stock, so it's not going to be looking for big, huge movements. That's one thing we look at. And so then what did it actually do the day after of its expiration? So this is 1 day later after the earnings release. And so you can see very little small movement, down 1.2%. Here was kind of down 6%, you know, flat, up 1.5, flat, up 7. So not huge movements, you know, kind of contained, 7 being kind of the highest here. All right, so not these big price spikes, but just kind of smaller movements. And this is kind of thing that we then look to take advantage of, maybe for volatility crush. And so then you can see the implied volatility here, just kind of get an idea. Here it was going in the day before the earnings release. The implied volatility on this series was 73%. And then you can see basically, you know, behind that, it's typically JP Morgan is around 20 in the 20s. And here it was the day later after the earnings released on a Friday. So it went out trading at 207 the day before the earnings release. The next day it was at 204. So not a big move. And then you see the implied volatility crush went from 73, you know, cratered down to 22, the normal. So that's what we're going to look to take advantage of in this kind of trade. Not big movement, but volatility crush. So it was trading right here going in, and here's where it was the next day. You can see that volatility crush on the chart there. So it was down, you know, 0.79%. So this was a perfect candidate type trade for, you know, trading volatility crush. And we did this with the iron condor kind of credit spread to take advantage of that. So here was, you can see the risk profile of this trade. You're going to have, this is going to be what we call the iron condor credit spread. So you're going to be having a call and a put credit spread here, looking at something like that on the profile. The total potential profit is going to be, if it goes between the two spreads, would be $45 would be your potential profit. The risk is the difference in the spread. So in this example, it's a $2.50 wide spread. So the risk is the difference, $205. So this is what we call a negative risk ratio trade, but that's typical of any kind of a volatility crush trade, okay? So we get 45 bucks, we keep that. That's a 22% return in that 1 day period. So these are typical of the types of trades that you'll look to put on just specifically for volatility crush. And that's what you got here. So you can see it was going in, it was traded at 207.57. The next day when we took it off, it was traded at around 205. The implied expected move going in was for 3.12% move up. And then, you know, looking over the 5 cycles, you can see it doesn't have huge movements here, 3.36. And then set this thing up for a price move of no greater than 4% up or down. All right, so we wanted to capture kind of anything between 4%, kind of a little bit more than that 3% to kind of give us some, you know, kind of a little bit of leverage room to the upside, a little bit of cushion. All right, so here's then what the trade was set up looking like here. The delta, as you can see, kind of getting an example. So the short strike on that put debit spread side was going to be the 200 strike. You can see it's a 16 delta. So, about 1 standard deviation out of the money. We're on that short strike there. And then on the call side, you can see it was even a little bit further out of the money. It was at 11 delta. All right, so we're going to be short that and short that, those 2 strikes there. And so those are the deltas. You can kind of get a feel for, where it was based on kind of standard deviation probabilities. And so here's the profile of the trade when it was set up. Nice iron condor credit spread. So here you can see our call credit spread side here that was put on. Now you can leg in or out, but we typically put these things all on at once. Here's the put side. And so this brought us in a total of, $45 credit. We received, $23 credit on the call side and 22 on the put side. So these are not, you're not going to have a huge killing as far as money, but these are the probability type trades you're trading just to trade volatility collapse. So that would be one here. You're very typical of these types of trades to play the implied volatility collapse. So that's your iron condor credit spread. That was JP Morgan example on that. Now, this is a strategy used for the big price spikes, explosive moves, and we do a lot of these. There are a lot of specific stocks that have these huge movements. So this is the kind of strategy that I like to use, for these types of trades. So this again is going to be a defined risk trade. It's going to be a debit spread setup, non-directional. We have no idea if the market's going up and down. We just want a big explosive move to take advantage of. So it takes advantage of that earnings release price spike, explosive moves. These are also short duration, 1 to 3 days typically at the most. And so those are the typical trades that we're looking for as far as the setup there. So here's a couple examples of one that we've done. These were alert trade setups that were sent out to the members. This is one that was on AKAM. I showed you a little bit earlier. This was set up. This was back in November of 2024, but this is a good example. 9.4. You can see the implied expected moves are big on this. So, I do a specific screen to find these types of trades. Now, in the course, we'll go through how to screen and find these trades, okay? That's going to be a big part of the course next weekend. The screen, how I put the screen together, my data that I use, all that you're going to be shown how to use it and then analyze it. But you can see here's the data going in at what we can potentially expect it to do. And then here's what it's actually done in the past. The day after its expiration into expiration of that earnings cycle. So you can see here it was down on this cycle. It was down 21%, down 14%, up almost 11%, down 11, down 8. Here was that small one that I showed you earlier. So this has a tendency for these big price spikes up or down. Okay, so then how do you trade it? So this is kind of the setup. Went through this kind of trading analysis with you a few minutes ago. And then here's the chart of what it looked like going in. So here was AKAM going into the earnings release, was trading right here, right there, trading right at 98.15. Okay, so set the trade up into the close, trade at 98.15. The next day, what did it do? Collapse. Look what it did, just a gap down lower and closed down here. Closed down at 76.83. So the implied expected move going into this was 9.47% up or down. It actually closed down over 14%. Now what we did was we set it up inside the implied expected move, set this one up. All it needed to do was either move up 6% or down 6%, on the earnings close, okay? And so look at the volatility crush as well. So that's the chart setup. Now let's take a look at the risk profile and what it looked like. So here it was going in, the trade, we set up. So we set up this trade here. It looks something like this. And so the total cost on this trade was $145 of risk to make either 55 on explosive move and a close over the call debit spread side or below the put debit spread side, we would make $55. So the $55, that would be a 38% return in 1 day. So that's what you're looking at in these types of trades. So it actually closed down 21. So this was a pretty easy trade to go into. And so this was AKAM. And like I said, I'll be showing you how to find these trades next weekend. You know, when we go to the course, how to scan and look for these specific types of trades. So here it was on that risk profile, what it looked like. This one had the big, huge collapse. It was trading down there into expiration, way out of the money, 76.83, and we set this thing up $1.45. It blew out to our max profit of 200. So this was a 55 bucks in one day, or 38% return, playing that volatility spike, not volatility spike, but price spike up or down. And then this is another one that we did the last earnings cycle. This was on Affirm, AFRM. This was another one just set up. This was an earnings alert trade sent out. This is typically what it looked like. My alerts that I send out, if you do want to take the earnings package, they're very detailed. So if you've never even traded earnings trade, you can go through and read my detail of the earnings that I send out for the trade, and you could actually fall and just do the trade without actually having to know how to do it. But anyway, so very detailed there. Use what I call Telegram to send these out. It goes out within seconds when I put it in. And here it was the next day. So, you know, set this up. It was trading at, we'll go through where it was. It was trading at down here at 80 or something. And then the next day it spiked up and it was trading around 94. So we had a max profit on this the next day. So here's the trade set up on Affirm. And you'll learn how to, you know, find these stocks like Affirm next weekend at the actual workshop that we're going to be doing this in. So here it was, just kind of the data to give you an idea. This has potential for big, huge movements. Specific screen I look for greater than 6%. So you can see here the potentially big moves, and this is what it's done historically: big moves. Up 10%, down 14, up 21. Here's the small one. Here's the big 31 up, 9.5 down, 10 down. So it has potential for huge moves up or down. So that's what we took advantage of, that probability. And you can see here just kind of the earnings data that I put down here on this little spreadsheet. You can see the typical implied moves over the 5 series has been 14.2% up or down. And the actual movement at expiration over the 5 series was a move of 16.7% up or down. And over 9 cycles, a move of 16.32%, the smallest move over those 9 cycles was 4% down. All right, so just potential for these big price spikes up or down. And so we did this with this specific trade here. So it's trading here, going into the close on Thursday, had this huge spike up, but then, you know, moved down, but still a big move. So went from 80 on the close Thursday, trade at 88.45 into the close on Friday. And so we set up this specific structure to take advantage of this type of potential price spike. So did this trade here. So we had the 83.85 right here. So all it had to do is close above 85. And then we had the 77.75 R close below that. So I had the big price spike up, closed here at 88.45. We needed to close over 85 here. It did that. We kept the full 50 bucks on the spread. We had the risk of 200, lesser cost of the trade. 150 was a risk. $50 on 150, 33% return on that trade. So that was a pretty cool trade. And this was again alert trade there. Now here's kind of a really go-to one that we use a lot in the right situations, what I call my low risk to reward flexibility type trade. This is the double lightning earnings spread that we've been started using back a few years back, and it's really just pumped the results up great. And it's basically what we call a double calendar trade. So again, it's a very, very low risk trade. It's again non-directional earnings release type strategy, structured for low defined risk. Takes advantage of that pre-earnings high implied volatility that we can take advantage of to sell that volatility for the collapse, selling time and volatility. Great for, you know, profiting from the volatility crush or collapse. Allows also the trade to profit if there's a post-earnings trend. This is the really nice flexibility part of it. If we want to stay with the trade, we don't have to get out. You know, it's not a short duration trade where we're in at the end of the week, we're out. We can stay in this for another week, or we can even structure it for longer than that if we want. It's going to always have a positive theta, so there's no time decay in this trade. So it's great for that post-earnings trend trade if we want it. And it's just a great all-around strategy. So what set this strategy apart from the others that also sell volatility is that it can be then adjusted into a directional trade after the earnings release, providing you the potential for really big profit returns from any post-earnings trend directional move. And started to, use this strategy back in 2020. Gosh, it's been 5 years. It seems just like yesterday. But this is really created some really great results for the trade earnings service. So these are very selective trades that I send out. These are part of the if you do the elite alert service, this 5 different types of trades. This is one that I send out. These are very selective, and so from it starting this earnings trades back in 2019 through Friday, we've had 145 trades closed out. 106 winners, 17 break even, 22 losers. So win break even rate of 85%. Again, these are just a summary unaudited results, but very selective, high winning percentage type trades. Okay, so these are what you would get if you do have the alert service, which you can sign up for today if you want. So here's an example of how it works. This was on STZ. Okay, so just kind of going in through the data, you can see that STZ. Typically, not huge movements, 3.5%, 4 maybe. All right, so this kind of a certain screen, I look for these types of trade stocks, and then you can see, what has it done at expiration or a day later. Here you can see not much of a movement, up 2%, down 3, flat, down, up 1.4. So perfect for this type of strategy that I'm going to show you. Okay, so this is the double lightning. So here it was STZ, and this is doing that double calendar. The implied expected move going into the release was for a move of this to be up 3.5 or down, 3.5 up or down, and set this up for a move of 3% up or down. All right, so it's trading right here and had that movement there, taking advantage of that volatility collapse, but super low risk trade that we can even hang into if we want. All right, so here it was going in. You can see the implied volatility as we head into the earnings release was over 86%. So we had 1 day to expiration. It was going to be before the open the next day, but so we set this up the day before. STZ was traded at 242. The expiration was the next day. So you can see that implied volatility, big positive implied volatility skew there, 86%, and normally around the mid-20s. For STZ. So good, perfect candidate for this type of trade strategy. And then the next day, you can see it was trading at 247.53. Not much of a movement. You can see volatility collapse. Everything went back to normal. That's what we're taking advantage of. All right, so here's the thing that works and makes it so great. It's super low risk type of trade. So again, just going in, it was traded at 242 basically, expiration the next day. Expected move going in was for 3% up or down, basically. Trade setup, when I did the trade, was 3% up or down, was where it was trading. Really wide break even. To lose on this trade, it would have to be up over 4% or down 5%. The max risk on this trade going in was $150, and this ended up making $180. So really great trade setup. So you can see that the positive risk ratio on this actually made 120% return in that 1 day period versus, the iron condor credit spreads that I showed you earlier for volatility collapse. Those are going to make maybe 30% return. This made 120 and on very low risk. I'll show you some are even lower risk than that. So here it was, the spread went, blew out, and the spread was trading. If you add this up, 75 plus 75, the spread, the initial cost was 150, and the spread blew out to 330. This made, the next day was up $180, trading right here, almost perfect at the 3% up mark. And you can see here's your break even way out there on both sides. So this was a beautiful trade, 120% return on, on that setup. And then if we wanted to keep it, we could, because we're long still the next week out. But that's typically what we look for first. And then here's another one just to show you how cheap these things can be. This was on CL, and this was also set up for the same type of trade. And again, looking at this one through the screen, not big movements. Okay, we're scanning for low movements, and you see then the next day going into expiration, it's up about 2%, down 1.76, 1.932. So perfect setup for this type of trade structure. And so here it was going in, it's trading right there. Expected implied move going in 2.83. We set this trade up for a move up or down of 2.5%, and we got pretty close to it. It closed up at 2.3%. All right, so it went from 80.96. We had the volatility crush, you can see down here, set up for that with this trade. And then we also set it up for not a big movement of just 2.5% up or down, and it closed up 2.3%. So it's a really great, perfect close for this type of strategy. So this double calendar. And so here's what it looked like. Again, going in, you can see the implied volatility going into the day before it was going to be letting the announcement out. The 83 strike that we were going to be short here, had a 46.42% implied volatility, just to show you the volatility collapse, what it looks like. And then the next day, that 83 strike had collapsed down to 14. Okay, that's what we're taking advantage of. So that's what you're going to learn how then to do these structures next weekend. Okay, not only you'll learn how to find the trades, but then you're going to learn how to set these structures up. All right, so that's what we're looking at to take advantage of. One of the things, not everything, but that one of it, and that's how that works. All right, so here's where it went out, and this was super low risk trade. This trade, Max, look at this, $17 was the risk on this trade. All right, so going into the trade, it was trading at 80.96. This was set for expiration on the 26th, just one day, and it was set for a 2.5% move up or down. Look at the break even, 4% up, 4.5% way break even. Look at the break even point way out here. And so this went exactly where we wanted it to go, right about there. Trade cost $17. So this went out trading at 82.83 right there. And the spread we ended up with this was up $36. I mean, that doesn't sound like a lot. It's not a lot, but look at the return. The return on the risk of 17, a 211% return in that one day. So these are things that you can add to your trading portfolio. So, it's, these 4 times a year we have earnings season. So why not take advantage of it and have some fun and do these types of trades? So that's another example. Now here's just one more that I wanted to throw in there. This is one that we did on Exxon, just the last earnings cycle. And this was, it was going to have its earnings release on the 31st, and then the earnings the next day. So again, here's the alert that I sent out on the 31st. Exxon earnings double calendar. You read through this a little bit later, or we'll go through this next weekend, but very detailed there. And then here it was the next day. So when this was set up, if I can find it, it was trading at, going in, it was trading at 98.15, and then we had it going out when we took the trade off as 111.06. But this was set up for that volatility collapse type of trade. So this one was really perfect as well. So here it was trading where it was trading here going in the day before 98.15. And then we structured the trade for the expiration the next day on the 1st. Right here it was trading 111.06. And here's where the trade went out. This is what the structure looked like. This double calendar went out right here. And we look at the break-even points way out there. So this trade went from, our cost on this trade was $118. So the spread blew out to 175. So you can see it blew out. The call debit spread side was at 79. The put debit spread side blew out to 96. So we had that spread at 175. Our cost was 118. So 65 on the call spread side, 53 on the debit spread side. So that gave us a profit of $57 per spread, 48% return on that trade right there. So really, beautiful setup, really big positive theta on that trade. So that's just one more example. Now the next one that we'll look at, and I'll show you how to use next weekend, is what we call, I call the pairs trading strategy. This is kind of a market neutral strategy we can set up to use to trade any kind of post-earnings trend. All right, so when we're looking at using pairs or spreads to trade in a market kind of neutral fashion or strategy, it can be used for trading post-earnings trend move on a stock after the earnings release. So by trading pairs or spreads, what this does, it mitigates, it takes away the overall market risk. Okay, so just think about like Friday. You know, if you'd had a pairs trade on and you're just playing the spread, it doesn't really matter if the market, you know, was down 2% or up 2%. You're just playing the spread between two specific assets, okay? And so if they're correlated and that correlation changes, that's what you're trading. You're not going to be affected by the overall market risk. So it's a great way to trade post-earnings trend trade on selective stocks that do tend to trend. So by, you know, simultaneously taking opposite positions on related securities stocks, then allows you to reduce your exposure to any broad market movement. So with a pairs trade or spread trade, then you're equally likely to profit whether the market you're trading is up, down, or sideways. It doesn't matter. So what you're looking at trading and making your profit off is the spread between two specific assets and how they correlate to each other. Okay, so what we're going to do in the course next week, and I'm then going to show you how to set up a pairs trade for any post-earnings trend, but we're going to use a synthetic option structure, so you're not going to have to pay high cost of you buying shares or selling short shares. We're going to do it with options, synthetic option, long, short. Now think about this. So if you are, let me take another sip of my water. So let's say, let's for example, I'll pick out, let's say the example I'm going to show you is going to be the QQQ versus Apple. All right, so let's say that you have, these are the pairs you're going to use. So and the example I'll show you here in a minute, it's going to be going long like QQQ and actually short Apple. So let's say that QQQ, the ETF, goes up faster than Apple, which will be short, goes up. Okay, so QQQ goes up real fast, but Apple, that will be short, goes up very, very low, very slowly. Okay, so we're going to be, in this example, the pair will be long QQQ, and then we're going to be short against QQQ. The part of the pair will be Apple. Okay, that will be the spread. So we're going to play the spread between QQQ and Apple. Apple, QQQ long, in this example, Apple short. So if QQQ goes up really fast or more than Apple, look at that spread. See that spread increasing? That's the profit. Or we could have QQQ goes up and we could have Apple go sideways. What happens? That spread widens, we profit. So if we bought the spread here, we profit from it widening out. Or we could have QQQ go sideways and we could have Apple start going down, spread widens. Or we could have QQQ go down, but Apple's going down faster and that spread widens. Or we could have QQQ going up, Apple going down, spread widens. So that's what you're playing. So you're mitigating, taking out the overall directional market risk that could, you know, hit your trade. It's not going to affect the pairs trade. Okay, so pairs then can be structured, and that's what we're going to be. I'm going to be teaching you how to do this next weekend using a synthetic pair that will be used to mirror or kind of replicate the underlying securities that will be long and short. So in this situation, we're going to be long a synthetic long with QQQ, or and short a synthetic short with Apple. So their cost is super low versus the shares, so it really gives you that leverage. But we're also going to be using this as a pairs trade, so it will lower your trading costs. Also ends the hassle of borrowing shares. So if you've ever tried to short shares, I don't know if you've done that before, you actually have to borrow the shares in order to short them. But if you do it with a synthetic short, you don't have to do that. So it's a really great way to do it. So here's just an example to show you what a pairs trade actually would look like. So here's Apple. You can see it, going up, has a nice trend up, and then you see Apple, having a bad day and trending lower. So this was back in May. You can see it was trading down here, at 165, and then just goes up, and then here's, back in August, trading down. Okay, so this is what we're going to then take advantage of. Just kind of see the chart here, and then here's what the spread would look like. So this would be just kind of without adjusting the spread for cost or anything. This would be just kind of a 1-to-1. So you can see when this started, this was at May 4th. And this would be if you went long QQQ short Apple, that spread at that point in time right there, that spread was going for QQQ was $152 per share above Apple at that point in time on the 4th of May. Now look at the spread. So the spread is in this right here. You see that's the line chart. So that spread starts going up. So basically what's happening is QQQ is going up more than Apple, and that spread is widening. But it doesn't matter if the market is going up or down. It's just playing the spread. So that spread's going up, and it went up here, that blue line from 152. It went up here to this 191 here on the 18th of July, right about there. And so at that point, it was at $191. Now, if you look at that, you take 191 less than 152. This was a $39 per share move up. Okay, so from here to here, from 152 to 191, that's $39 a share. Now, if we did this or done this with a synthetic long short, remember one option contract's equivalent to 100 shares. So if we did this trade with a synthetic long one option contract QQQ, short one option contract of Apple, this trade would be up $3,900. Okay, that would be your pairs trade, how that would look. And then here's another, here it was on the 3rd of August. It was traded at 183 right here, and then it went from 183 QQQ over, that expanded and increased out here right here to 201 on the 14th. So that is an increase there of what is that? That's $18. So it went from here to here. That's up $18 per share. If you did synthetic long short with one option contract, that's $1,800. Okay, so this is a way, the catalyst for the pairs to move is earnings. So in this situation, Apple, had earnings results that were not not what the market was expecting. The market was looking for a bigger movement from Apple after, from its earnings, and Apple didn't provide the earnings to give it that. So QQQ actually was going up more than Apple in that situation. So I'll show you how then to set these pairs up and how to screen for these types of trade setups. So that's going to be part of the course too that will be next weekend. And here's just one more example to show you, what this would look like. So here's like Nike, and so here's Nike earnings one for this example on the 29th of June. It was trading at 113. So right here you can see where it was, goes down. And then here was just another one on the 28th of September trading here. It had a spike up. Okay, so here's the pairs right here. Now this one is actually adjusted for dollar equivalent. So they're kind of a dollar adjustment to make each one kind of dollar equivalent to each. And I'll show you then how to set that up next weekend in the course as well. And that's typically how we'll do it. We'll make these dollar equivalent, okay? So here was where Nike was trading here on the 26th. You can see the spread right here. It was trading at 72 over, right here. Where was, let me see, right here. See the red right there? Barely see it. So at that point, Nike, hold on one second here. Right here, right there. At that point on this was when the earnings were released, the day after on the 29th, before the day before it was released, Nike was $72 above SPY on an adjusted basis, okay? One-to-one kind of adjusted, okay? So it was $72 above SPY. Now, then you can see what happened. Nike had bad earnings. What happened? Nike started going down but SPY was going down less or going up. So it didn't matter. It was just playing the spread between Nike and SPY. So the spread was, it was getting crushed versus SPY. So this would, you'd be short Nike, long SPY, and this was spread, is what you would get. So then that spread went down from 72 over, it went to right here, 14 under. So it had just got annihilated. So that was a move of 72, and then you had the 14 where it was down here. This was a movement of $86 per share. If you did this with the one option contract, one short Nike, long SPY, that would have been up $86 per share, or per 100. One option contract equivalent to 100 shares, you'd be up $8,600. All right, so that's what you're going to learn how to do in these kind of post-earnings trades. So if you've done this spread where you were short Nike, or you could look at the other way around, you're long SPY, short Nike, that spread went from 72 over, 14 under, it was up $86, $8,600 a share per 100. So one contract, right? And then here's the other one right here. This is where it went the other way around. So this is where Nike had good earnings, and it gave the catalyst for Nike to start really expanding, moving out faster than SPY. So at this point, Nike was trading at $2.50 under right here, that blue line, and then it started widening on the spread. So it started performing better than SPY. So this was, long Nike, short SPY, went from 2.5 under, Nike under SPY, to 81.5 over SPY, right up here. So that was an increase of 2.5 under plus the 81.5 over, $84 per share, which would be $8,400 if you did this with the options, okay? So that's going to be part of the course, what we're going to go through as well next week. And so there's a lot of great stuff that you're going to learn here. And today I just wanted to show you, all the different things that we're going to cover next weekend. So, what works using synthetic approach for finding the highest probability trades, not synthetic, but systematic approach. Now, will every trade be a winner? No, it'd be great if it would be, but we're going to look for the highest probability trades, and I'm going to show you then how to scan for those and then set them up for these types of trades, for selective earnings trades this earnings season. So let's go through and talk a little bit more about how you can start profiting from these kind of high volatility earnings season trade setups that we're going to get into next weekend. So I'll show you here what we're going to offer here, this course package. Now, I gave you that link earlier, so this is what you're going to get. We'll go back through this a little bit more detail. So if you have any questions, let me know. But we'll start next Saturday, the 18th at 11 a.m. Eastern till 2 or however long it takes. Everything will be live, but also recorded, broken down in 30-minute modules, kind of like a chapter of a book. So we'll start next Saturday, and then we'll finish up Monday, the 20th at 4 p.m. to 5. We'll use the same link, so we'll send that out to you. And then we'll have a dedicated Q&A the next day. So if you have any questions, you can come in the next day at that Q&A. So you're going to get everything, all the enrollment bonuses and everything. So today for $167. So just put in that powercycletrading.com/special right there. You can click on it or copy and paste it, and then put EAR earn 15 small cap promo code, and that'll give you that discount, and that'll put the price down to $167 for you. All right, so that's basically the course price there. Here's a little bit of nice feedback from Mark. He said, Larry's a great teacher. I've had a few, and Larry by far is the best. I also enjoy his earnings course. I made 3 earnings trades in the past couple of weeks. Larry would be very happy. I followed his teaching and traded Broadcom, AVGO, for over 1,000% winner. So I must say, I'm not sure if things are finally starting to click for me or if it's Larry's awesome teaching, but I'm trading better than I have ever traded in the past 3 years, closer to 4 now. It's probably a combination of both. Anyway, I'm not tooting my own horn here, just wanted to leave a comment that is positive for Larry. I've been through a lot of different programs, seminars, and trading groups. What you're doing here is by far the best in my opinion, Mark G. So I really appreciate that and wanted to pass that on to you so you can see what you're going to get here next Saturday. So here's just that rundown kind of summary of what you're going to get in course package 1. Course package 2 is the alert service and everything in package 1, but here's package 1. So for today, now when I go out again, like I said, it's going to be 197 next week, but make sure if you can sign up today and you'll get it for 167, and you'll get my earnings course to kick off on demand, so you get started right away. You're going to get my membership to my trading club for 30 days, and you can start when you want, and then you can renew this if you want. We've got different packages as well, or you can potentially upgrade to the alert service if you wanted. And then you've got start trading options today right here. You're going to get that. You're going to get my follow-up support Q&A. You're going to get my Greeks, how to use the Greeks right here. And you're going to get trade list of my earnings trade list of the best stocks to trade there. So that's what you're going to get, if you do package 1. And again, so it's all for you. Now, let me back up. For the membership here, I'm not offering the alert service actually as an upgrade. You can only upgrade to certain packages. I've got other membership packages for a year or something like that. But the alert package is really selective, and I don't send that out except on as it's tied to the earnings course, etc. So just kind of wanted to actually point that out. So if you do want the alert service though, here's what you're going to get on that. So you'll get everything in course package 1, and that alert service will be. Let me get to that page here. Flip it here. So if you do want to add the alert service, that's course package 2. You're going to get this. You're going to get all 5 of the alert services for 4 months, plus 4 months to the trading club, and everything in course package 1. Okay, and you can start and stop this thing when you want. You're manually. We've got it set up so you can. If you do go on vacation, you can start it, stop it back when you come. So you're not going to use your time up. And these are 5 different types of alerts that I would send out. Very selective, either butterfly or condors. Calendar, counter diagonals, we do a lot of those. Butterfly, calendar, kind of what we call penny trades. Breakout reversal trades, these are typically credit spreads or debit spreads. And then selective earnings trades when in earnings season. So those are the 5 typical types of trades that are sent out. And again, use that promo code powercycletrading.com/special, and then that earn 15 small cap. Now, if you do the alert service, it'll be today 507, and that's going to get everything that you have it here. I'll show you. It'll be 597 when I send out next week. Today 507. You'll have access to all 5 of the alerts. Now, when I send them out, they're very detailed alerts that I send out, telling you how to do the trade, basically profit targets, things like that. Or you can do, a lot of members just do their own thing. They just want the alerts, and then they just, buy the shares or the short, or, do the options or whatever. But I'll always give you a specific option trade setup. All right, so there are 5 different alerts here, and typically, 8 to 12, per month stocks, or sometimes ETFs. So when sent out, you get a kind of a guide to the alert, why I'm setting it up, what the details are there. Then I do a trade set video review after it. Trades are listed and archived. Then you'll have access every week for the next 4 weeks to my recorded live and Q&As that are live and recorded. I do a daily video newsletter every day after the close. You'll have that for the next 4 months. Access to my virtual trading room for the next 4 months, and then discounts on any course or trading software. On my website, PowerCycle Trading, you'll get a discount code, members code, which will give you 50% off. So all those are kind of the benefits there that you'll get from package 2. And then here's kind of a summary of the alerts. I showed you this a little bit earlier on the specific trades for the last 4 trade alert services from first of the year this year to the end of yesterday. We're running about 85% win rate, really high rate this year. The market's been good, but very selective trades. 104 trades closed out, 74 winners, 14 break even, 16 losers. So win, break-even rate, 85% unaudited. So a summary there, and then here's just kind of what it's done since inception of all the different forest services together. We've had running still a high win rate, based on over this period of time, 5, 6, 7 years. That's pretty good. We're running 79% win rate, win break-even rate, 936 trades closed, 672 winners, 69 break-even, 195 losers. So I like to keep the win rate up, and that's what we've been able to do by very selective trades that I send out and find. Again, unaudited. Now, here are the earnings trades, and these are going through, started back in 2019 through Friday. We're running really high win break-even rate on these. These are very selective ones that I send out. All right. So this is what you're going to get if you do sign up for the alert service. You'll be getting these types of trades. All these are incorporated into the service, and then here's everything there. So I guess I'll just skip through that. But here's what we're going to cover in the course. Okay, so when we get into the course next weekend, we're going to start out with part 1. We're going to go through the 5 steps for finding these trades, the analysis that I use. Now then there's a 7-step screening process that I use to identify the good high probability winners. We'll go through the option pricing, how that works for these types of trades. Important to kind of understand the Greeks there. And then I'll show you my resources that I use for these earnings trades for the history. So we can go back and look at earnings history of these specific trades and see what they've done, into earnings and after earnings. Okay, so we'll go through the resources there, and then how to use this resource that I use to scan and put together your watch list of these trades to capitalize on these earnings types of trades. So we'll go through that. We'll go through the different scans that I set up. There are 3 to 4 specific scans that I use. So I'll go through that in the course, and then you can do it yourself in the next, the next go around. But what I'm going to also provide you is a current list of those scans before the course starts. Okay. So then in the course, you'll learn then how to analyze your earnings watch list to see how these stocks perform, or analyze it before they go into their earnings release and then after. So you can look at what you want to find for setting up the trade to see if it's a good trade, based on an earnings release trade or post earnings trade. So we'll analyze that with the data, the resources I use there. Then, then we'll go through the steps that I use to put together the watch list. Okay. And then we'll go through the actual trades. So that's kind of part 2. Part 1 is just the setup, and part 1 is about as important as part 2. You need to know what stocks to select and what stocks not to do, and then the trade setups. Okay, so then we'll go through the setups using the iron condor, which is that kind of high probability credit spread for volatility collapse. Go through the iron condor debit spread for the price spikes, and the double calendar. So we're going to go through these specific 3 strategies in the live course, which is also recorded. And then you're going to get, in addition to that, you get the on-demand course. Then we'll go through all the other type earnings strategies that you could use. There are 5 different ones. In this live course, we're going to go through these 3 and then the pairs trade. Okay, so we're going to have enough time to go through all those. So then you'll learn, how to use these. So here's just the best strategy I've found, basically this double calendar. And so we'll go through that. And then we'll go through the details of how that's used to, what are the, optimal strike prices to set up for the double calendar, how to structure the initial setup through option expiration, and then, how to adjust it. So if we're going to keep it, sometimes we'll keep the trade for a post-earnings trade, and then I'll show you how to do adjustments to what we're trying to do is turn it into a zero risk trade. All right, so a really cool structure there. I call it kind of flexibility trade. And then we'll go through the next part. We'll go through the pairs trading. Okay, so this will be part of the live course as well next weekend. And again, just to summarize it, it's kind of a market neutral strategy that can be used for trading your post earnings trend move on a stock after its earnings release. So the strategy will totally change your trading game plan. A lot of my members that have learned these pairs trade, that's a big part of their trading now is using spreads. Okay, so it's going to be a great thing that you can learn for everything that you're doing in the future if you want to add this to your portfolio. So the earnings pairs, I'll show you how to identify and select the best earnings stock pairs trade setup based on earnings release. Then how to statistically measure the pairs correlation. You want to be able to find the best thing to pair with it. So there's a certain way to do that with a correlation tracker that I use. I'll show you how to do that. And I'll show you the resource for that. It's a free thing that you can use. And then how and when to set up the pairs trade. And then how to set it up using a synthetic long short. That's a big part right there, the synthetic long short structure. So a lot to cover there next weekend, but you're going to learn a lot of great stuff. And then the recorded course, though, will then go through the other strategies that I'm not going to really have time to cover in the course in detail. So it'll show you in the recorded on-demand course how to use the long iron condor debit spread. Again, we're going to go through this. That'll be part of the live, but this will be in the recorded course, the iron butterfly. Okay, so this will be in more detail there. So just a lot of stuff that you're going to get, and you'll be, a master of, how to use these trades in the future if you want to take advantage of the earnings cycles that come every 4 times a year. So how to construct these trades based on the earnings implied move, how to calculate the implied move, and then how and when to set up the trades, manage, and then you're going to also get a trading library. So you're going to get a really good trading library of past trades that you can go through and look at. That's a really great way to learn, is looking at past trades. So you'll get all that. All right, and then here's nice feedback from one of my members that was at the course. Yeah, here, George, here's that link again. Put that in there. And then earn 15 small cap. All right, and then you're ready to go. Yeah, the time will start on 11 o'clock Eastern, 10 Central on Saturday. And this was from Mary. She said, this course explained in clear, simple terms how to trade options on stocks that were coming into the earnings report. Larry showed in specific source, he showed a specific sources of information he uses to determine which of the strategies is most appropriate for the stock that is reporting based on historical data. He gave specific guidelines as to use each, and also the exit strategy. He goes over the material in great detail and shows examples of strategies from past performance. One thing that impressed me with each course that I've taken is his willingness to repeat explanations as someone asks for clarification. So, that's why, I take as much time as needed to make sure I can answer questions as we go. Larry schedules the classes for certain time frame, and because he wants to ensure that each participant has understood the information, he most often goes over the planned time frame because he has stopped to answer those questions thoroughly. So that's a pretty good kind of summary of what you can expect, next Saturday. But everything will be recorded too, so you can go back and review it. So here are the special bonuses. So you're going to get, to start with the earnings course that I did in the past, 7+ hour course, 428-page PowerPoint. So this will get you started, and this will go through pretty much everything that we're going to cover, but there's even more so additional stuff like the iron butterfly. So this will go over the earnings double calendar, iron butterfly, long condor, debit spread, the credit spread, and then also the double calendar, okay? So very, very good course here. Get you started, get you going before even next weekend. So I'm giving that to you as that additional bonus there. And then you're going to get a 30-day trial membership to my trading club. All right, so this will give you access to my virtual trading room. So this will be open to you from Wednesday to Friday from 9:30 to 10:30 a.m. Eastern. Okay, but then we'll start though actually Tuesday, because on Tuesday I'll do a live Q&A that's live and recorded, and we'll start there. So you'll get access to that every week, and then you'll have access to the live trading room every week from Wednesday to Friday. And then I do a daily video newsletter to tell you, kind of give you an update on the market, how my overview of that, what we're doing in the trade room, what trades we're looking at. And then we'll get a members trading video archive for these. The Traders Educational Vault, some really good educational material for you there in your educational vault, and 50% discounts on anything on my website, all courses, and I've got a lot of software that you can buy as well. Now, one thing I always like to point out is, Jay, a long member, he said, reading books is fine, but seeing the actual option trade setup makes really a huge difference. So that's the benefit of getting the virtual trading room and also that Q&A every week. Then you're going to get my this bonus course here, Start Trading Options Today. So it's kind of an intermediate course, but it's a great course for you to start with if you're not up on your options quite enough, or you want to get a little bit of a tune-up. So it gives you the benefits, options versus stocks, the things you really need to know, option basics, mastering the puts and calls, how option expiration works, and then goes through and covers 3 different strategies to teach you in this course: how to use covered calls, and then how to use your income protected put collar, which is a great strategy to know right now, and then also how to use the vertical debit spread. So that's in this course here to get you started, or just add to your your option trading library there. All right, and then bonus 4, we'll do a follow-up Q&A, which will be dedicated to the earnings course. So that'll be Tuesday. And then you have access to the virtual trading room that you can get that additional support. And then you'll get my, this additional course here on the Greeks. So it's a 60-page guide with videos very specifically dedicated to how the Greeks work: delta, gamma, theta, option pricing, what I call the market maker's secret, the standard deviation, how to use delta and trade probability. So you'll get that as a bonus. And you're going to get my earnings trading watch list. So this will be 3 different types of screens that I do that are going to be based on looking for those stocks that have those movements of greater than 5%, and then also screens for 7% max and 5% max. And then we'll, in the course, I'll teach you then how to set these screens up for yourself going forward, okay? And then, how to use the data to analyze it. So that's a big part of the course, really, is this scanning process to build your list. So you'll get that. Here's just kind of a past example of what this will look like. This is like list screen 1. This was for, like a move of a maximum of 7%. So these are all the different stocks that came up in the screen for that. Shows you the recent close, kind of the average volume, the earnings dates, etc. So that's a kind of screen 1 that I'll send out. Plus, you're going to learn to do this yourself. Okay, so that's going to be a big part, learning how to do it. Okay, list 2 is going to be looking for this screen and max of no greater than 5%. So you can see all the different stocks that came out on that screen. And then the next screen is for stocks greater than a 6% move. So these are for the big price spikes. So you can see what comes up here, like things like Spot, Etsy. You can see Twilio, Team, Palantir, all those different stocks here. AKM is one I showed you earlier, and so those came up. All right, so then that screen is set. So that's what you're going to get on that, and then that's all the kind of the bonuses. And then here are just kind of what you're going to get with the alert service. So for example, Dan said, you're very diligent and totally thorough with your analysis. That's the foundation of the success of the alerts. I paid for the subscription with my first 4 trades I took with you when I was just learning how to trade options. So that's the great thing. So when I send out the alert, they're so detailed, like Dan just followed it and just did the trades, and he was able to pay for his service. And then Scott says, it'll be the best investment that you ever make. Go with the Elite Package, great group of traders in the trading club as well. Now, when I send out the alert, okay, there are 5 different types of alerts I send out. I'll always give you a suggested option trade. And again, just to clarify, a lot of the members just want the trades that I find to send out, and they do their own thing. But when I send it out, I'll give you a specific option trade. I'll give you the entry level, profit targets level based on what I call price action support and Fibonacci support resistance, and what I call price target mapping, basically. I'll tell you what option series to be using, stop loss guidelines. I'm constantly monitoring these trades all through the day for you, so you don't have to really do anything until I send the alert telling you to do something. The trades are then listed and archived, and so you can go back and look at them. And I use, again, just to point out, I use this service Telegram, so you can see here just here are a few kind of adjustments and alerts, just constantly. This was from Friday the 10th. I was sending out these things when we had Amazon, NEE, Gilead, GILD, Amazon. So, these are, kind of the things that you'd be expecting to get with Telegram, which is a free service. So that's how I send everything out. And then I give you the trade setup video review at the end of the day, so you know kind of more why I did the trade, get more comfortable with it. Then the daily video newsletter, review the markets there. Then we do the weekly Q&A, which is live and recorded. And then you'll have access to the virtual trading room during the week, and 50% discounts on anything on my website, courses and trading software. So if you come over to the website, after when you're a member, then you can go into courses here. You can go into trading software. So any courses that I have, you can come down here, click on that, go to trading courses, and then everything you see here, all the different option courses, all the different courses. If you want whatever you want, click on it. You'll see the price, $297. This example, just go in here and you'll have a members code that you can put in, and that'll knock off members login. Well, that goes to your login page, sorry. So you get you can buy this, and then you'll get the members code, and I'll give you 50% off. All right, so that's how that works for anything on my website. And that includes a lot of different software as well. So you can see here, if you want any of my trading indicators, volatility scanner, custom indicators here, and that's where you can go to get it. And it's 50% off the price on the website. All right, so a lot of great stuff there. And then here are a few, examples of the alerts that have been sent out, so you can see what to expect from the alert service here, give you an idea of that. So here's a couple of the earnings trades that have been sent out. I showed you this one earlier. This was AFRM, Affirm. This was the last earnings season, okay? So this one was doing it for a big price spike, and ended up right there. So this was up, max profit. Again, very selective. We're running 85% win rate, okay? Here was the Exxon trade. I showed you this earlier. This was from the last earnings season cycle on the 31st of July. So here's that trade I showed you earlier. Here's another one. Here's Carvana. This was on the 30th of July. We set this one up. You can see how detailed these are. I should tell you exactly how to do it. Here's the one that we did on Carvana. And it was trading going into the earnings. It was trading right here. This one had an explosive, huge price spike right here. And we got out, and that one worked out perfect. And that was on Carvana. This was one that came up in our scan. So you can see where that one went out right there. So this is a max profit trade there. Made $60 per spread, 31% return on that. Okay, so there are just a few of the earnings trades to give you an idea. Now these are we do a lot of then calendar and counter diagonals. It's a summary of these trades since inception. So you can see here, started sending these out back in 2019 through Friday. We've had 372 trades closed out, 265 winners, 27 break-even, 80 losers. So win break-even rate have run 78% win rate, break-even rate on that. Again, unaudited. Here's a couple. This one we actually still have on. This has been a killer trade. This is one that we did on NEE, which was the utility. All right, so this shows you going in. We set this trade up back on the 24th of September. We're still in this trade. So it was trading at 72.62. And we started this thing out with what we call a calendar diagonal at cost of about $1.80. Did a number of different adjustments that I send out by the alerts. And then October 1st, this shows you, the trade profit. I'll go through the trade in a minute. And like I said, we're still actually in this trade. So we're trying to squeeze out even more profit. So here's this. It's been an incredible trade. Just look at this trade. We got it right here. Perfect entry based on my indicators that I use. So we had a reversal, momentum, and then it just started breaking this moving average. Started trading up. We did an adjustment here, profit take, adjustment here, profit take, adjustment here, and still in it right there. So this trade has just been a huge winner on the move to the upside. And here's just kind of give you a sampling of the profits in this trade. So this was the original trade set up as what we call the calendar diagonal. Long the 17 October, 72.5, short the 3 October, 76, and $1.77. On this date, the 25th of September, it was trading 74.59. It was up $92 per spread, 52%. Now look at the progression of this trade. So then here's another, on the first, it was trading right here. We had made an adjustment. We made a number of different adjustments. Now we were adjusted to long the 75 17 October, short the 82 at $1.15. Spread blew to 403. We're up $288, 250% return. That was on the 1st of October. Then we're staying with the trade. And then on the 8th of October, here's where it is right here. We were trading right here up to 84.08. Okay, so we went from 72.65, now 84.08. Now we've adjusted this trade into actually a free trade. From the amortizing down of the trade, all the profit that we've taken, we adjusted this trade actually into a credit of $51. Okay, so you can see here now the spread is blown out to 589, plus we have actually a credit from all the profit that we've captured, so a 51. So this trade is up $640 per spread, zero risk, and we're still in the trade. All right, so we'll see what happens next week. So now the trade, here's where we are. NEE was, here's one of the members that got into it. This was just, this is what we call the home run. This share is from SP. This trade was just a fantastic trade. So, you know, with options, you chip away, singles, double singles, and then you just get these big ones. So now we've got this adjusted to a free trade into a debit spread. So now we're long. That's still that base 78 in the 17 October, and then short against the 89 17 October. And this is now adjusted with, we've got a $27 credit, zero risk. Potential next week to make over $1,000 on this spread with zero risk. Okay, so that's where we are now. We're just sitting with it. We'll see what happens. We can take it off here for pretty good profit. It went out here Friday. You know, the markets came off. Even with the markets coming off on Friday, this went out right here. We're still up $585 on this trade. And if we get a move up here to 89, we'll be up over $1,000. We may sell something against it next week to bring in some more premium, so that'll be part of it. So that fantastic trade. So that's one we just did. We did this just recently too. This was on Walmart. This is another really great trade, alert trade. So I'll just kind of go through these quick. This was set up on the 3rd. We did some adjustments on the 4th, the 8th, the 9th, the 12th. And so just kind of go through and show you, this was another really, really great trade setup. Again, alert trade, got in right here. See the momentum shifting, see the nice trend. Adjustment here, profit. So I won't spend too much more time. I'll just go through the progression of the trade. So here was kind of the initial trade setup right here. We were long that 98. September 19, and then short against the 12 September 103 at 215 or 215. It blew up to 413, so we had that spread to 413 less our spread cost of $198, 92% return at that point, but we're sticking with it. That was on the 8th. And then here it was, we adjusted this into a long call condor on the 9th. Now it's trading at 102.20, so we adjusted this trade. This is what you would get to a condor, long the 99, call short to 104, and then we shorted against it to bring more premium, 105, 110. Now we have this trade reduced down to $60 was our cost, adjusted cost, with the potential to make $500 spread width, less our cost, potential for $440 or a 733% return. And we pretty much, you know, got that. We came very close to that trade. We ended up right here taking that trade, the additional profit right here on the 17th. It was trading at 105.18. So we had that spread now blown to 360. Our cost was 60. We made $301, 502% return. So that was a really sweet trade on that. And then here's just the butterflies, selective butterflies. We've done since the 19th, 2019 through Friday. We've had 238 closed out, 172 winners, 19 break even, 47 losers. running a win rate, break-even win rate 80%. Sometimes these trades will make 20 to 1. These are just huge potential trade profits. So that's a look there. Here's just an example of one we did recently. This was on Amazon. There was the alerts, out the 21st of July, adjustment the 24th, profit take the 25th. And so it's trading right here. And here we got adjustment here and closed out the trade right there. So here's the trade setup, kind of the profile. You can get an example of what it looked like. So this was adjusted then into a long call condor. And this was on the 21st. So it's trading 227. So now we have this adjusted to the 227 F 230 debit spread and then a credit spread against it, 235, 237.5. Cost of the trade $1.05 adjustment and potential to make 145, 138% return on that potential return. And that's where it went right out there between our two spreads. So we ended up making that 143 bucks or 136% return on that. And then these are really cool, selected, very selected. These are what we call the lotto ticket. Occasionally we'll get this pinning trade set up that looks great. And this is one that we did on SPY. I put butterfly, looking for this downside move. We had targeted down here to this kind of 560 strike area. And so we set up, this was a pinning trade where we had the risk on this trade, a total of 39 cents or $39 of risk. So we set up a butterfly targeting this 560 strike. So went from 565, 560, 555. So that put butterfly, max risk 39 bucks, potential profit $5 wider, 500 lesser cost, $461 or over 1,000% return if we hit our target right there. That's the perfect spot. And so that's what we set up on that butterfly pinning trade. This was the alert trade sent out to the members and ended up, going out right there, pretty close to it. Now we're scaling out, but this is where it went out right there at going into expiration of that 560. So that was pretty almost perfect. 39 bucks to 456. So over 1,000% return. So these are, an idea of what you're going to get if you do want package 2. And again, just kind of one last go around here to summarize everything. Here's everything you'll get. And if you do it today, 167 bucks, all these additional benefits and bonuses, and access to the live and recorded course next Saturday. So make sure to sign up. I'd sure like to see you there. So put in this link here, powersoccertrading.com/special. Let me get that one more time. And then earn 15, and you're going to be ready to go. And I look forward to working with you and seeing you either this week or next Saturday. So put that in, and then that promo code EARN15, and you'll be set. So this is good for either course package 1, which comes with all the different bonuses here, 167. Or if you do want to include the alert service, you can have that for the next 4 months. Plus it gives you everything in course package 1, and that'll be 507. Well, thank you so much, everybody, for being here. Thanks, SP. Thanks, George. Thanks, Barbara. Thank you so much. And